Good morning. In today's webinar, we are tackling one of the most misunderstood topics in retirement planning. Who is considered a disqualified person for a solo 401k? If you've set up a solo 401k, chances are you've heard the term disqualified person. But do you really know who falls into that category? Can your spouse invest alongside your solo 401k, for example? What about your parents, kids, or even your business partner? And what happens if you accidentally transact with a disqualified person? Understanding this is not just important, it's critical to protecting your retirement funds from IRS penalties. We're going to cover all these items today. So today's topic again is who is a disqualified person for solo 401k. During these daily webinars, we encourage you to also ask questions. It doesn't have to necessarily be regarding today's topic. It can be any aspect of solo 401k plans, self-directed IRAs, as well as 401ks. As those questions come in, we will pause and answer them. I see we have a question here already. Let's take a look at that. Can you convert from an after-tax 401k contribution to a Roth IRA if you are under 59 and a half and still working for the company under the solo 401k plan? Great question. So yes, that's known as the mega backdoor Roth strategy, whereby you make a voluntary after-tax contribution to the solo 401k, and then you can choose whether you want to convert that to the Roth solo 401k or the Roth IRA, and you can convert it to the Roth solo 401k or the Roth IRA regardless of age. So whether you're age 59 and a half or younger or older, the mega backdoor Roth solo 401k strategy is an exception to the conversion rules where you can choose to convert that voluntary after-tax solo 401k contribution to a Roth IRA instead of converting it to the Roth solo 401k. Now, there's another rule out there that deals with pre-tax solo 401k funds that you want to convert. That's known as an in-plan conversion, where you convert pre-tax solo 401k funds to the Roth solo 401k. Those have separate rules than the mega backdoor Roth strategy. When you convert pre-tax solo 401k funds to a Roth solo 401k, you can do that regardless of your age. However, if you want to convert those pre-tax solo 401k funds to a Roth IRA, you typically have to meet a triggering event, such as being age 59 and a half or older, or if you've transferred IRAs or former employer funds to the solo 401k plan that are pre-tax funds. Those pre-tax solo 401k funds can also be converted to the Roth IRA or the Roth solo 401k. And some, don't confuse the rules that apply to voluntary after-tax solo 401k conversions as part of the mega backdoor Roth, which allows for converting those voluntary after-tax contributions to the Roth solo 401k or the Roth IRA versus converting pre-tax solo 401k contributions that you make to the plan. Those can only be converted to the Roth solo 401k if you are under age 59 and a half. If you're over age 59 and a half, those can also be converted to the Roth IRA. And again, there's that exception for funds that you transfer from IRAs or outside former employer plans to the solo 401k that are pre-tax funds. Those can also be converted to the Roth IRA regardless of your age, or to the Roth Solo 401k. So as you can see, the IRS is full of quirky rules that apply to certain facets of solo 401ks. And that's an example there of the various contributions, how they have their own rules, not only when they're being converted, but they also have their own rules when they're being distributed. So those are items to keep in mind. Okay, good question. Again, please like today's video. Please subscribe to our YouTube channel to help get the word out to other solopreneurs like yourself. So let's continue with our topic for today, which is who is a disqualified person for solo 401k. For those who are viewing this video for the first time or joining us live for the first time, it's worth noting that we go live typically every day. And oftentimes we go live a couple times a day, and we use these daily webinars to cover specific topics, but also to answer questions surrounding retirement accounts. As always, please also visit our community where you can post blogs. You can even post forums. We have over 30,000 members in that community. If you're an advisor, or a CPA, or even a real estate professional, insurance professional, really any type of business, you can also join my community. It's free to join, and you can post guest blog posts so you can flex your knowledge out there, and you can even link back to your company website, so that way those members can visit your website if they're interested in maybe your services, or they want to know more about what type of services you offer. We also have our YouTube channel. Again, if you subscribe to our channel, you'll receive notifications when we go live. We also have a large video catalog on that YouTube channel, over 900 videos and growing. And all the daily webinars that we present are posted there. So again, we cover separate topics each time we do a webinar. We also have the artificial intelligence. The address for that is www.solo401k.ai. All right. So again, feel free to type over your questions during today's daily webinar, and we'll pause and answer those questions as they come in. So again, we're talking about the disqualified rules. We're trying to figure out who's a disqualified person when making solo 401k investments. And we talked about how that one mistake with the disqualified plan regulations could result in having to pay taxes from your solo 401k. So it's a pretty important topic, and hopefully you learned a lot from it today. So why does this matter? Well, you want to protect your retirement plan from costly mistakes, because if you transact with the disqualified party, it's going to be ruled as a taxable distribution, or even more, as a prohibited transaction. So we're going to learn about which family members you can transact with when utilizing your solo 401k for investing versus those that you cannot, and also how to avoid those prohibited transactions. Okay, so let's pull up the slide here regarding disqualified persons. So the disqualified person means that if you want to make a solo 401k investment, let's say you want to invest in real estate, oftentimes our clients like to invest in alternative investments, whether it's trust deeds, promissory notes, rental real estate, or even private equity. And oftentimes they're not sure whether or not such an investment can be made. Well, one, the plan does allow for those types of investments, but you have to be aware of disqualified persons. So, for example, on this list here, we've got your spouse listed as a disqualified person. So what that means is that if you want to invest your solo 401k, let's say you want to invest your solo 401k in a private equity fund, a real estate syndicate. And let's say that your spouse is the general partner of that LLC or limited partnership of that real estate syndicate. If you invest your solo 401k funds in that limited partnership or LLC, that would be considered a prohibited transaction because your spouse works for that limited partnership. He's an employee, officer, or director, or he's the partner of that limited partnership. So, other examples of disqualified persons would be your parents. So, you notice there it's referring to your natural parents and also your adoptive parents. Those are also considered disqualified parties. So, another example, let's say that your parents are looking to retire and they approach you and say, hey, we want to buy a rental property down in, let's say, Florida, so that we can move from the East Coast and spend at least the winter months down there in Florida. And they ask, well, why don't you invest your solo 401k in this property and we'll go ahead and rent out property from your solo 401k. And that way you're going to have a chance to grow your retirement account. And instead of us paying rent to someone else, we're going to pay it to your retirement account. Well, unfortunately, that would be a prohibited transaction because your parents are also disqualified parties, which means that in the context of real estate, for example, when your solo 401k invests in, let's say, a rental property, your parents cannot use that property even if they pay market rate rent, even if they only use it for a day or a few days or a few months out of the year. They're considered disqualified persons. Therefore, your parents can never rent out property that's owned by the solo 401k plan. Same thing with your children. Let's say your children are going off to college and you found a really good property on campus and you like to invest your solo 401k in that property and then have your kids use it while they go to college. Unfortunately, they're considered disqualified persons as well. So that investment would be considered prohibited. So when it comes to disqualified persons, you've got certain people and businesses and parties that are considered disqualified. So your spouse, your children, your parents, even those providing services to your solo 401k plan. Let's say your CPA provides services to your solo 401k where he or she files the annual tax return for that 401k or does any type of reporting. Your CPA is considered a disqualified party. So just like in the example above, whereby if your solo 401k invests in a rental property, your parents cannot utilize that property, so they can't rent it out. Same is true for your CPA because he or she is providing services to your solo 401k plan. So that's considered a prohibited transaction and disqualified. Also, let's say that you are self-employed, because obviously to open a solo 401k, you have to be self-employed. Let's say that you invest your solo 401k in a property and you want to have your business use that property for business purposes. That could be considered prohibited as well because that's your business. So that one there is a little more tricky because there is an exception under the IRS regulations whereby if you use a certain percentage of that property for your business activities, then that's an exception, but there's a percentage test. And when that regulation was promulgated, it was probably done so without thinking about self-employed solo 401k plans and more so for full-time employer traditional 401k plans. So another example of a disqualified party is if you want to loan your solo 401k funds to your business as a promissory note. We're not talking about a solo 401k participant loan where you borrow from the plan and you use those funds for any purpose because you're borrowing from the plan. That's known as a solo 401k participant loan, and that has its own regulations, such as being able to borrow no more than 50,000. That's the maximum amount, and having to pay that loan back typically within 5 years, and the loan is to you. In this example here, we're talking about where you want to loan your actual solo 401k funds to your business. So the funds flow directly from the solo 401k plan to your business. That's prohibited because your business is considered a disqualified party. You can't loan money from your solo 401k plan to your business, even if it's done as a promissory note at fair market value, where the business pays a, let's say, 8 or 10% return on an annual basis to that solo 401k. It doesn't matter. That's disqualified because that's your business. Same, another example, if you want to loan funds from your solo 401k to your spouse's business, that's also prohibited because your spouse is a disqualified party. Same thing if you want to loan funds to your son because he wants to start his own business. That's prohibited as well because he's a disqualified party. So these are examples of disqualified parties again. Same thing if you have some type of real estate trust. You can't do business with your solo 401k in your real estate trust. So rule of thumb is that if you're trying to process a solo 401k investment with any of these individuals up here, or a business that you own, or your own living trust, family trust, real estate trust, your business, or someone that provides services to your solo 401k, those are disqualified parties. Okay, let's take a look at some more slides here. Again, go ahead and type over any questions you have during the live webinar. We'll pause and answer those questions as they come in. So the core definition of a disqualified person is essentially someone that provides services to your solo 401k plan. Those are typically considered disqualified parties, as well as family members, such as your spouse, children, your parents. So those would, if you transact with those individuals, that's going to be considered a prohibited transaction. Now, as far as certain family members that do qualify for making solo 401k investments, therefore they are not considered disqualified parties or persons, that would be your siblings. So your brother or sister, they're not considered disqualified parties. Nonetheless, if you make an investment with your sibling, your brother or sister, you need to make sure that it's done at fair market value. For example, let's say your sister owns a rental property and she wants to sell it to your solo 401k plan. As long as that's done at fair market value, so an appraisal will need to be performed on that property, and then the solo 401k purchases that property from your sister directly, that would not be considered a prohibited transaction because siblings are not disqualified parties as long as the transaction is done at fair market value. Another example is, let's say you want to loan funds from your solo 401k to your brother. Well, that can be done through a promissory note where you loan the funds to your brother, and preferably you want to do it as a secured promissory note, typically by real estate, so that way in the event of default, the solo 401k's recourse would be that property securing that note. When loaning funds as a promissory note to your siblings, you need to make sure that you charge an interest rate that's fair. So charging your brother a 0% interest on a promissory note from your solo 401k would be deemed prohibited, because when you make a solo 401k investment, you have to do it with the intention of benefiting the solo 401k, and it's got to be done at fair market value. And of course, the IRS is going to look at that more closely if you're doing an investment with a sibling, even though a sibling is not considered a disqualified party. That doesn't mean that you can loan funds from the solo 401k to your sibling at a 0% interest rate. Likewise, if you charge a rate that's too high, that could also be challenged. So the general rule of thumb is you want to charge a rate based on that borrower's credit history. So if obviously if that individual has good credit, then if that individual were to go to a bank, what kind of rate would that individual receive on a loan? Let's say 4%. Well, you could use that same rate when loaning funds from your solo 401k as a promissory note to that individual, so your sibling. So again, also other parties that are not considered disqualified would be your cousins. So that would be okay. Also, if it's let's say you know someone in your circle that has a business and that individual is not related to you, nor do you do any type of work for that individual's business, then you could also loan funds to that individual's business or even invest in that individual's business through the solo 401k, because they're not considered a disqualified party because that's not your business, nor are you an employee, officer, or director of that business. Looks like we've got a question here. Let's take a look at that, and then we'll continue with today's daily webinar, which is who is a disqualified person for solo 401k investment purposes. All right, thanks for doing these streams. Where can I check that my payment method is up to date with you guys? I will go ahead and if you go ahead and submit a ticket, we'll go ahead and take a look at your account to determine whether or not you're up to date, and then we'll email you accordingly. Let me provide you with the link to submit that ticket. So a support ticket. Keep in mind, we don't have access to your solo 401k funds. So when we are invoicing you, those annual fees can be paid with personal, business, or solo 401k funds. And you can typically pay by credit card or by check. And I'm going to provide you with the ticket where you can submit a support ticket. You go to submit a support ticket there, and we'll check your account to see if it's current on fees. Okay, so again, today's topic is who is a disqualified person for solo 401k? We've been going over this topic at great length. Let's continue here. We've given some examples. And as far as best practices for avoiding mistakes is to, before you make an investment, reach out to your CPA, attorney, or even your solo 401k plan provider and run the transaction by your solo 401k provider. Your solo 401k provider can't provide tax or legal advice, but they can provide educational support. For example, clients at my solo 401k financial email us, or we speak to them all the time when they want to make some type of investment, and we go over those regulations so that way they can make an informed decision as to whether or not that such an investment is going to violate the prohibited transaction regulations, and then they'll go back and discuss it further with their tax professional. And we are well versed on the regulations, whether we're talking about investment regulations, which oftentimes that's where the prohibited transaction rules come into play, as well as identifying who's a disqualified person, We're also well versed on the contribution regulations, distribution regulations, conversion regulations, decedent account regulations. So upon your death, what happens to your solo 401k funds? Bottom line, we are well versed on all regulations regarding solo 401k plans. So again, we encourage our clients to ask questions, attend these daily webinars, even email us, submit support tickets, schedule calls, and we'll gladly go over any regulation. Specifically, we're talking about disqualified persons. We'll gladly review investments with you to determine whether or not those are going to run afoul with the regulations. So that way we can help educate you, and then you can make an informed decision after discussing it with your tax professional. So that's how you want to avoid making mistakes. And another rule of thumb is that typically if it's too complicated, that generally means it's a disallowed investment. If you're trying to push the envelope when you're dealing with retirement accounts, that's a good sign that it's probably prohibited. It's probably a disqualified type of transaction, or it's a prohibited investment. So the rule of thumb is to typically not make such investments if it's too complicated. I mean, we've helped clients review investments, I mean, for the past 15 plus years, and we've seen every investment under the sun, and including those that are very complicated and you're pushing the envelope, and 99% of them are prohibited or they're being made with disqualified persons. So again, a good rule of thumb is that if it's too complicated and you're trying to push the envelope, it typically is disallowed or prohibited. Okay, again, go ahead and type over your questions during today's daily webinar, and we'll go ahead and answer those questions as they come in. Let's take a look at this slide here. Here are some prohibited transaction examples. I've already provided a few, but let's talk about these here. So here's an example: selling your existing property to your solo 401k plan. We actually get this question quite a bit. I would say this is probably one of the top 3 prohibited transaction questions that we get, where the individual has the rental property or even their primary residence, and they want to unload that property, and they have a good chunk of money in their solo 401k plan or even an IRA, and the individual wants to open a solo 401k plan, transfer that IRA to the solo 401k, and then they want to invest in real estate. In this case, they want to have the solo 401k purchase a property that they or their business already owns. And they even say they want to do it at fair market value. Well, unfortunately, that's a prohibited transaction. Why? Because you are a disqualified party. You can't have your solo 401k plan purchase a property that you personally own or your business personally owns, even if it's done at fair market value. So you can't sell the home that you own or your business owns to the solo 401k. That's considered a sale or exchange of property between the plan being the solo 401k, and the disqualified party, the disqualified party being you as the solo 401k participant / owner of the plan. Here's another one that we get quite a bit as well, especially if you're looking to purchase your first primary residence. You can use your solo 401k property as security for a loan. Let's say the solo 401k owns a rental property, and now you want to purchase your own primary residence, and you're trying to get a loan from the bank. You can't utilize that solo 401k owned property or any assets of the plan when trying to get a loan from a bank. So you can't use any asset of the plan as a security for a loan that you receive from the bank, even if it's going to be used towards the purchase of your primary residence. Now, don't confuse, as I mentioned earlier, the solo 401k participant regulations, where you can borrow from your own solo 401k plan, and you can use those proceeds towards the purchase of your primary residence. And you can use it towards the purchase of your primary residence, and you can extend that loan to a 15, 30-year payback period. And the maximum you can borrow from a solo 401k through a solo 401k participant loan is 50% of your account balance not to exceed $50,000. So for example, if the value of your solo 401k is $50,000, the maximum you can borrow is $25,000. On the other hand, if the balance of your solo 401k is over $100,000, the maximum you can borrow is $50,000, and you can use those proceeds towards the purchase of your primary residence, and you can pay that loan back over a 15 or 30-year period, depending on your mortgage. Typically, you can only borrow for a 5-year period, but there's the primary residence exception, where if you borrow from the plan, and that as long as that loan is documented, it's got to be documented with specific solo 401k participant loan documents. And here in my solo 401k financial, we'll draft those solo 401k participant loan documents along with the payment schedule. So it's got to be documented. You can't just document it on a napkin or on an envelope. You got to have specific IRS participant loan documents. And then you pay back the solo 401k with principal and interest, scheduled payments over that 15 or 30-year period if the funds are used towards the purchase of your primary residence. And there's no prepayment penalty. Okay, let's talk about some other examples of prohibited transactions. Loaning funds to your parents. You can't loan your solo 401k funds to your parents. Now, if you borrow from the solo 401k through a solo 401k participant loan, those borrowed funds can be used for any purpose. Because once you borrow from that plan, you personally, through that participant loan regulation, you can use the funds for any purpose. So you can loan those funds to your parents, but that would be outside of the plan, and that would be a loan from you personally to your parents. But you cannot loan your solo 401k plans directly to your parents. Why? Because they are a disqualified party. Same thing with your children. They're also considered a disqualified party. Same thing, we already talked about that. You can now loan your solo 401k funds to your business. Again, you can borrow from your plan through a solo 401k participant loan, and then you can use those funds for your business, but the loan is not to your business, it's to you. So you have to pay that loan back with personal funds if we're referring to a solo 401k participant loan. This example is where you're loaning funds directly from the plan to your business. That's prohibited. That's disallowed because your business is considered a disqualified party. Same thing if you loan funds to your spouse's business. You can now loan your solo 401k funds directly to your spouse's business. So these are good examples of disqualified persons and prohibited transactions. Okay, I don't see any other questions for now. Looks like we are at the end of our session. We'll be back again here in a few hours. So if you didn't have a chance to ask your questions during today's webinar, we'll be back again in a couple hours. Again, please like today's video to help get the word out to other solopreneurs like yourself. Please also subscribe to our YouTube channel so that you receive notification when we go live. We typically go live at least once a day. Oftentimes, a couple times a day, like today, we'll be going live again. Okay, so we've come to the end of our session. Until next time, have a great rest of the day.